Welcome to Financial News Daily, your trusted source for the latest global financial updates. And today's episode is a special masterclass: Real Estate Investment. We are going to answer the questions I receive most often from our community. Should I buy land or apartments? Should I pay in full upfront, or pay in installments by progress? If I have $500,000, what type of apartment should I buy? 1 bedroom? 2 bedrooms? 3? And the most important question of all: what return on investment should I realistically target? 10%? 20? 30? By the end of this video, you will have a clear, globally informed framework to make your real estate decisions with confidence. Let's get into it. Asset class number 1: land and townhouses. This is the oldest and most universally understood form of real estate investment. The core advantage is simple: land does not depreciate. Buildings age. Land does not. In emerging markets, Vietnam, Indonesia, India, and parts of Africa, land near developing urban corridors has historically delivered the highest long-term capital appreciation of any real estate asset class. However, land comes with critical risks that many first-time investors underestimate. First, liquidity risk. Land is the hardest real estate asset to sell quickly. In a crisis, you cannot convert land to cash in days or weeks. It can take months or years. Second, carrying costs. Land generates zero income while you hold it. You pay taxes, fees, and opportunity cost for every year it sits empty. Third, legal risk. In many developing countries, land title disputes are common. Verification of ownership documents is absolutely essential before purchase. The global verdict on land investing in 2026: excellent for long-term capital growth, 10 to 20 years. Poor for short-term income generation. Best suited for investors who do not need cash flow from their investment. Asset class number 2: rental apartments and condominiums. This is the dominant investment vehicle for global real estate investors in 2026. According to PwC and the Urban Land Institute, investors worldwide have shifted their focus toward assets capable of sustaining recurring income and consistent occupancy. The simple reason: in a high-interest rate environment where borrowing is expensive and capital appreciation is slower, cash flow is king. A rental apartment that generates 5 to 8% annual yield on its purchase price is outperforming many bond markets and some stock portfolios. Key global rental yield benchmarks for 2026. Dubai, 8 to 10% annual yield, the world's highest for a major city. Tax-free rental income. Strong expat demand. Madrid, Spain, 5.3 to 5.9% yield. Stable. Strong tourism and young professional demand. Kuala Lumpur, Malaysia, 5 to 7% yield. Affordable entry prices. Growing tech sector workforce. Emerging U.S. cities. Detroit, Cleveland, Toledo are generating gross yields of 9 to 21%. But these require professional property management and carry higher risk. The global average rental yield across established markets sits at 4 to 8%. The message is clear. Rental apartments in the right location remain one of the most reliable income-generating investments available in today's financial environment. Now, one of the most debated questions in real estate investing. Should you buy a completed apartment with title deed, paying in full now? Or should you buy an off-plan project, paying in installments as construction progresses? Let me break down both options clearly. Option 2, off-plan project. Paying by installment as construction progresses. The advantages are equally compelling. 1. Entry price is typically 10 to 30% below what the same property will cost when completed. This is built-in capital gain from the moment you sign. 2. Installment payments. Spread your capital commitment over time, typically 2 to 4 years. This preserves cash flow and allows your remaining capital to work in other investments simultaneously. 3. In fast-growing markets like Dubai and Southeast Asia, off-plan buyers have seen 30 to 60% price appreciation before the building is even finished. The risks you must manage. 1. Developer risk. Research the developer's track record. Have they delivered on time before? Do they have strong financial backing? 2. Market risk. If the market softens during construction, you could be locked in at a price above market value upon completion. 3. No income during construction. You are carrying the investment for 2 to 4 years with zero rental return. The global investor consensus for 2026. Off-plan in a rising market with a trusted developer offers the best capital gain potential. Completed with title deed offers the best income security and lowest risk profile. For conservative investors, buy completed. For growth-oriented investors with patience, off-plan in a fundamentally strong market. Now, the centerpiece of today's episode. You have $500,000 for real estate investment. Should you focus on 1-bedroom apartments for young professionals, 2-bedroom units for young families and couples without children, or 3 and 4-bedroom apartments for wealthy tenants needing more space? Let me give you the data-driven answer. 1-bedroom apartments. The high-yield, high-turnover play. Research published in 2026 confirms 1-bedroom apartments are projected to be the most resilient asset class for rental investors this year. They appeal to high-earning individuals, young professionals, and mobile couples who prioritize location over space. The financial case is compelling. Gross rental yield for 1-bedroom units typically runs 0.5 to 1% higher than larger apartments in the same building. Why? Because the purchase price is lower, but rent per square meter is higher. In Madrid, a 1-bedroom delivers 5.29% yield on average, with some prime locations hitting 8.18%. In Singapore, 1-bedroom condominiums have shown rental yield advantages over 2-bedroom units due to strong demand from the mobile professional demographic. The risks to understand. 1-bedroom properties are more sensitive to oversupply in cities with heavy apartment development pipelines. They also have a narrower resale market. Most buyers of 1-bedroom condos are investors, not owner-occupiers, but for pure rental income maximization. With lower capital entry, one bedroom is the most efficient vehicle. With $500,000, you could acquire 2 to 3 quality one-bedroom apartments in markets like Kuala Lumpur, Tbilisi, or emerging European cities, creating a diversified rental portfolio from a single capital base. 2-bedroom apartments, the Goldilocks zone of real estate investment. If 1 bedroom is high yield and 3 bedroom is high value, then 2 bedroom is the sweet spot. That balances both. Here is why 2 bedroom is the single most recommended apartment type for investors. In the current global market, target demographic is the largest. Young couples, DINK households, double income no kids, small families with 1 child, remote workers needing a home office. This is the fastest growing renter demographic globally in 2026. Tenant retention is significantly higher. Renters in 2-bedroom apartments stay an average of 2 to 3 years longer than 1-bedroom tenants. Lower vacancy means more consistent income. Resale market is dual purpose. 2-bedroom units attract both investors and owner-occupiers. This broader buyer pool means faster resale and stronger price support. During market downturns, capital appreciation is more consistent. Unlike 1-bedroom units, which can be volatile in oversupplied markets, 2-bedroom apartments tend to hold value more reliably through market cycles. With $500,000 in a market like Dubai, Lisbon, or Kuala Lumpur, you could acquire 1 premium 2-bedroom apartment in a high-demand area, generating 6 to 8% annual yield, while benefiting from long-term capital appreciation. Or, you could split the capital, $300,000 into a 2-bedroom in a primary city, and $200,000 into a 1-bedroom in a high-yield secondary market. This is the diversification strategy that professional real estate investors are implementing in 2026. 3 and 4-bedroom apartments, the premium play for affluent tenants. This is a fundamentally different investment thesis. You are no longer targeting young professionals or couples. You are targeting wealthy expatriate families, senior corporate executives, high net worth individuals who want space, privacy, and prestige. The financial dynamics are different. Rental income is significantly higher in absolute terms. In Manhattan, New York, a 3-bedroom luxury apartment now rents for $17,000 to $25,000 per month. That is extraordinary income. However, the yield percentage is often lower than smaller units. Why? Because the purchase price scales faster than the rental premium. A 4-bedroom apartment in Manhattan costs $2.2 to $3.9 million. The yield sits at approximately 4.66% below the 1 and 2-bedroom yield. The risk profile is also higher. Vacancy periods are longer because the tenant pool is smaller. 1 month of vacancy on a $25,000 per month apartment is a significant cash flow gap. The verdict on 3 and 4-bedroom units. For a $500,000 investor with $500,000, you cannot fully acquire a 3 or 4-bedroom apartment in a top-tier global city. You could use leverage, putting $500,000 as a 30 to 40% deposit on a $1.2 to $1.5 million property. But in a high interest rate environment, the mortgage cost will heavily compress your yield. 3 and 4 bedroom premium property is ideal for investors with $2 million or more who are targeting capital preservation over income. For a $500,000 budget, stick to 1 and 2 bedroom units. Now, the question every real estate investor wants answered. What return should I realistically target? Is 10% enough? Is 20% achievable? Is 30% realistic? Let me give you the honest, data-driven answer. 10% annual return. The realistic base target. A 10% annual return on real estate investment in 2026 is entirely achievable and should be your minimum benchmark. Here is how it breaks down. In a market like Dubai or emerging US cities, gross rental yield alone can deliver 8 to 10%. Add 2 to 3% annual capital appreciation, and you are at 10 to 13% total return. 10% is not exciting, but compounded over 10 years, $500,000 at 10% annually becomes $1,296,871. That is nearly 2.6 times your original investment, achieved through stable, predictable real estate. 10% is the foundation. Build everything on this. 20% annual return. The achievable stretch target. 20% is achievable, but requires strategy and timing. The two most reliable pathways to 20%. Pathway 1, off-plan in a rising market. Buying an apartment in a pre-construction phase at 20 to 30% below market value. Then selling or refinancing upon completion and appreciation. This has been the standard playbook in Dubai, Ho Chi Minh City, and Jakarta over the past decade. Pathway 2, value-add renovation. Acquiring an undervalued property, renovating to a higher specification, then re-renting at a premium, or selling at appreciated value. This strategy consistently delivers 15 to 25% returns in markets with a strong middle-class upgrade cycle. 20% is realistic, but it requires more active involvement, market timing, and execution skill. 30% annual return. The exception, not the rule. 30% happens, but it is not a planning assumption. It occurs in 3 specific scenarios. 1. You bought in an emerging market at the beginning of a rapid growth cycle. Early buyers in Dubai in 2020, Ho Chi Minh City in 2015, or Bali in 2018, saw 30 to 60% returns. 2. A macro event dramatically shifts demand in your favor. A new metro line, a new airport, a new technology campus nearby. 3. You used leverage intelligently. If you put $200,000 as a deposit on a $500,000 property, and it appreciates 15%, your actual return on the $200,000 invested is 37.5%. Leverage amplifies returns, but it also amplifies losses. The honest principle for real estate ROI. Target 10% as your floor. Design your strategy to achieve 15 to 20%. Accept 30% when the market gives it to you, but never rely on it as your base case. Sustainable wealth in real estate. is built on consistent 10 to 20% returns over a 10 to 20-year horizon, not on chasing one extraordinary deal. 30% annual return. The exception, not the rule. 30% happens. But it is not a planning assumption. It occurs in 3 specific scenarios. 1. You bought in an emerging market. At the beginning of a rapid growth cycle. Early buyers in Dubai in 2020. Ho Chi Minh City in 2015. Or Bali in 2018. Saw 30 to 60% returns. 2. A macro event dramatically shifts demand in your favor. A new metro line, a new airport. A new technology campus nearby. 3. You used leverage intelligently. If you put $200,000 as a deposit on a $500,000 property and it appreciates 15%, your actual return on the $200,000 invested is 37.5%. Leverage amplifies returns, but it also amplifies losses. The honest principle for real estate ROI. Target 10% as your floor. Design your strategy to achieve 15 to 20%. Accept 30% when the market gives it to you. But never rely on it as your base case. Sustainable wealth in real estate is built on consistent 10 to 20% returns over a 10 to 20-year horizon, not on chasing one extraordinary deal. Let me summarize today's masterclass in 5 key principles. Principle 1. Land is for long-term capital growth. Apartments are for income and liquidity. Know which one you need. Principle 2. Completed apartments give you income from day 1 and 0 construction risk. Off-plan gives you entry price advantage and capital gain potential. Choose based on your risk profile. Principle 3. With $500,000. Focus on 1 and 2 bedroom apartments. They offer the highest yield, the broadest tenant market, and the most liquidity. 1 bedroom for maximum yield. 2 bedroom for balanced yield, growth, and stability. 3 and 4 bedroom are for investors with $2 million and above. Principle 4. Target 10% as your minimum return. Design for 15 to 20%. Celebrate 30% when it comes. But never bet your financial future on it. Principle 5. Location. 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 In 2026, add one more word. Location. 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 Liquidity. Always be able to exit. That wraps up today's Real Estate Masterclass on Financial News Daily. I hope this framework helps you make smarter, more informed decisions about your real estate portfolio. And before I go, one important reminder. Everything shared in this video is for informational and reference purposes only. All data and analysis are based on publicly available market information as of May 29, 2026. This is not financial advice. This is not a recommendation to buy or sell any property. All information presented here is purely for your reference, to help you think more clearly, not to tell you what to do. Every investor's situation is unique. Please consult a qualified financial advisor or licensed real estate professional before making any investment decisions. If today's masterclass added value to your journey, please give us a like and hit that follow button. We publish new financial insights every day, designed to help you Stay ahead of the market. Your financial future matters. Stay informed. Stay ahead. See you tomorrow. Right here on Financial News Daily. Option 1, completed apartment, pay in full. Title deed in hand on settlement day. The advantages are significant. 1. You take possession immediately. You can rent it out from day 1 and start generating income. 2. There is no construction risk. What you see is what you get. No developer delays. No quality surprises. 3. Banks lend more willingly against completed properties. If you need leverage in the future, title deed properties provide stronger collateral. 4. Resale is faster. Buyers prefer properties they can occupy or rent immediately. The disadvantage: completed properties in prime locations are priced at market value or above. There is less room for early-stage capital gain.